Hello and welcome back. Now this is a relatively short lecture just to look at the powers of the liquidator. Now these powers are the same whether we're looking at a voluntary or a compulsory winding up. And broadly, the power rights of the directors will now cease because the liquidator will take over control of the company. Now, what is his role? Well, it's to settle the list of contributaries, i.e. who can give funds to the company. So we might look at the directors particularly for either wrongful or fraudulent trading, or also breach of duties. Many of the cases we looked at in the directors section were cases brought by insolvency practitioners when they were winding up an insolvent company. The other people who might have money to contribute are shareholders who haven't fully paid up their share capital. And there also may be some charges and some transfers which can be avoided as well. So he'll have a look at that. We'll have a look also in a moment. He'll try and collect and realise all the company's assets, and he'll use that to meet the company's debts. If there's any surplus left over, he will use that to pay the company's shareholders some of their initial investment back. Now, one of the key things that the liquidator will look at is whether there are any charges that can be set aside. So this table here is very useful, and it's pretty easy for the examiner to test this kind of thing. So what have we got? Well, first of all, charges. Security for debt, for loans. Well, if it hasn't been registered on time, you'll remember from the previous chapter, that means that that charge is void against the liquidator and the creditors. The debt is still owed, but the creditor is an unsecured creditor. A floating charge may not be valid if it was created within 12 months prior to the winding up. And sometimes that can be extended to 2 years if that charge was given to a connected person. Now, there is a reason for that, and the reason is that in those last few months of a business going under, quite often there's a bit of a grab for security, and a bank who may have been quite happily letting the company run up an overdraft may suddenly decide that it wants security for that overdraft. And if they do so, they're sort of getting an advantage over the other ordinary creditors who aren't in a position to ask for a floating charge. Transactions at an undervalue can be set aside. Now, this is any gift or sale which reduces the assets of the company. So if you sell an asset at less than its market value, or if you give assets away. Now, it's only going to qualify as an undervalue if, at the time of the transaction, the company was unable to pay its debts, or if the transaction made the company unable to pay its debts. However, there is a bit of a defence here. So if the company entered into the transaction in good faith, it was for the purpose of the business, and they really thought it would help the business, you know, that sort of last-ditch attempt, sell some assets at slightly less than the market value in the hope that that will improve your cash flow position. Okay, now those transactions can be set aside if they're made within 2 years. Also, preferences. Now, a preference is where you try to give one creditor sort of preferential status over another. So perhaps you pay a loan that you owe to your spouse before you pay a loan that is owed to a supplier. And again, this will only be the case if at the time of the preference the company was unable to pay its debts. There is a small caveat to that, which is where the preference was for a connected person, as in my example, a spouse. And in that case, there is no need to show that the company was unable to pay its debts at the time of the preference. Now, that might seem a little confusing, and you do need to understand these rules. So let's have a look at Trading Limited, and I think we'll do this one together. So Trading Limited has begun a process of liquidation in February 14. It's had following resolutions by the members and creditors to wind up the company. Archibald and Duke, the two directors, have been researching insolvency on the internet, and they're concerned over a number of transactions entered into over the past few years. And they tell you this important fact here. The company has been unable to pay its debts since April 2013. And we have to advise them which ones of these transactions could be set aside. Well, a floating charge in favour of Adam plc was created in March 2012. Now, that is more than 12 months ago, and the rules say that a floating charge, can be set aside only up to 12 months unless it is to a connected person. Now, for the purposes of questions like this, I would always assume that something is not connected unless the examiner tells you otherwise. What about B then? A sale of 10 cars in March 2012 for £80,000. Archibald and Duke knew that they were probably worth over £90,000, but they honestly believed the sale would be in the best interest of keeping the company afloat. Well, that one's interesting, isn't it? They've sold cars at less than their market value. That's an undervalue. But they honestly thought it was in the interest of the company. So, again, that transaction is probably safe. So it's an undervalue, but with a defence, if you like. Part C then. A purchase in August 2013 of some car spurs for £10,000, which Archibald made as a bit of a favour for the vendor. Do people really do that? He suspected that they were only worth £7.5. Again, that is a transaction at an undervalue because he's paying more than the assets were worth. Therefore, the net assets of the company have been reduced. When did he do that? Well, he did it in August 13. Now, that means that this particular undervalue is within 2 years, and an undervalue within 2 years can be set aside. So this one is an undervalue, and it's within 2 years. Then finally we have a loan to Duke made to the company a few years previously and was paid off in June 13. Well, Duke is connected, therefore the time limit we're looking at here, this is a preference. They're preferring Duke's loan over the other debts of the company, and therefore this is going to be a 2-year time limit. So this is a preference and it's within 2 years. So therefore it can be set aside. And what will happen is the insolvency practitioner will trot off and try to recover those assets for the company in order to make payments to the creditors. Now, this is also important. You should learn this list. This is the order of repayments. So who gets paid first? Well, it's a bit like a waterfall because the insolvency practitioner will add up all of the money that he can possibly bring into the company. He'll add up all the debts falling within each category, and then he'll work his way down the list. So first of all, he'll pay himself. Otherwise, there'd be no way you could ever appoint an insolvency practitioner to deal with the liquidation. If he can't actually pay himself in full, then he's not going to do anything else. But the chances are he can pay himself, and then he'll look at category 2. This is preferential debts, and this is basically employees, unpaid wages, unpaid salaries, money owing to pension funds. And if he can pay all of the employees in full, he'll then move down to category 3. But if he can't, then he will work out a pro rata payment so that everybody in that class of preferential debts gets paid the same proportion of their debt. Next category is floating charges. So they'll get paid up to the level of their floating charge. However, those ring fencing provisions under the Enterprise Act will apply. So we'll have a look at those in a second. Unsecured ordinary creditors come next. And then deferred debts. Deferred debts are dividends that have been declared but not yet paid. So if it hadn't been declared yet, it wouldn't even qualify in this list. But because it's been declared, it counts as a deferred debt right down the list because it's almost like shareholders' capital, isn't it? Which comes right at the bottom of the list. Okay, it's very important that you know that order. Now, ring fencing can be tested, not quite as important as the list we just looked at. But basically, ring fencing will only apply where the fund for distribution is £10,000. Now, if that fund is £10,000, half of it will be taken for the unsecured creditors. It's quite a big chunk, isn't it, of the floating charge holder's security. If the fund is more than that, then we'll take the first 50% of the first 10,000 and then 20% of anything over that limit. And it is worth noting there, if you are a floating charge holder and 50% of the secured assets were taken out of your category, then you then rank as an unsecured creditor, but you can't share in the ring-fenced element of that. You have to just share in the, the leftovers, as it were. So So again, let's test that on this question, buffers limited. I think you might be able to do this one on your own. So read the question, pause the recording and have a go, and then we can compare our answers. Okay, so there's my answer. So we've got this dividend that's been declared but not paid. That's a deferred debt. It comes quite a long way down the hierarchy. Liquidation costs, they come first. Then we have the floating charge. That's going to be third after the preferential debt, which is the employee's holiday pay. And Mr. Staples, he's going to come fourth. So first question, which debt's first? Well, the liquidation costs. Second part, will Mr. Staples get all of the money owed to him? Well, no. I've done a little calculation here and we can see that if we work down through that hierarchy, there's only £800 left by the time we get to Mr. Staples category 4, and therefore he's going to get £800 out of the 830. Will the members get the dividend? Well, no, because the money's long gone by the time we get that far down our waterfall. Do the ring fencing provision apply? No, because we have less than £10,000 in our fund available for distribution, so we don't need to worry about that. Okay, that's the end of corporate insolvency. I know it's quite a heavy topic, so you've done really well. Take a break, get a coffee, and then we've just got a short lecture to look at individual insolvency to follow.